It's summertime, which means it is summer school. Summer school session 2 is with our old friend Angie Setzer. Hello.
Hello, I'm so glad to be here.
Golly, it's good to have you here. I was reviewing some of our previous discussions, and there's a couple of topics that I want to get caught up. But before I get into my list, I want to know what your customer slash client slash friends, what's the hot topic people are asking about right now in very technical, detailed grain situations?
Oh, is this a sign of things to come, or are we, is this going to buck the trend of the last couple years? I think is the pretty common question, and I wish I had the answer because obviously it makes a very big difference in what you should be doing and all of those things. And so we'll kind of talk through all of that, I guess. But yeah, the number one question that I'm getting right now is like where do we go now? What do we expect here as we work our way into the last half of the summer? What are the biggest things that we're watching, obviously, and all of that? And do we see a repeat of the last couple of years? Do we get a $3 handle on the front month of these contracts? Does the December board trade lower? Those types of things that I wish I knew the answer to right off the top of my head. But pretty commonplace of what happens next.
Well, and the technical side of things with numbers and things like that is kind of what I think we're going to discuss a lot is technical things. But I ask this most weeks. You know how I like to ask certain things all the time. This one is the question of, in these volatile times, how does one protect thyself from a post, a bombing, a country doing something with or against us? That's just the world. It's not a political statement. That's just a reality of being protected.
Yeah. Yeah. I mean, there's a lot of different ways that you can go about it. Obviously, to a certain extent, you feel like we're kind of discussing a lot of things right now after the horse has gotten out of the barn, where it's like, have we missed opportunity or are we going to see more coming at us? What does this all look like? But yeah, I mean, the biggest way, the biggest resources, there's several different ways that you have to manage your risk. Obviously, that includes hedging on the board outright. You've got your revenue insurance, all of these types of things, packages, programs that they've been putting together in that regard. And then you have the old fashioned options and the different ways that, we could look at option strategies depending on what you're wanting to do. Obviously your puts and your calls and all of these things. And so there's a lot of ways that you can use all of those together as well to make sure that you're relatively well protected. And that's what I see a lot of guys do. A lot of folks do, I should say,
Yes.
these
Yes.
days.
All right. Puts and calls. That's where I want to start. I heavily want to discuss puts. Let's do the introduction of the term. What is it?
Yeah, so a put option is basically is something that you buy that helps you protect your downside risk. A put gains in value, the lower the market moves, and so a put is a very popular strategy for folks to push on the brokerage side, or it's a popular strategy for a lot of people to use, simply because it's one of those things that it keeps your upside open and allows you to kind of continue to roll the dice, if you will, and see how the rally develops as time moves forward. You're not committed to bushels, those types of things. And if the market moves lower, the option that you bought gains in value. And so that's where a put comes into place. It's the opposite of a call that gains in value when the market goes up. And it's just one of those things that folks like to look at to protect that downside risk, they say, when the market is providing potentially some opportunity that you want to cover.
Okay, so talk to me that I am Paul the farmer. Hello, Angie. I have 1,000 bushels of corn. Today's price is $4. I want to put. What does that mean?
Yeah. So the biggest thing is your option contracts are going to be 5,000 bushel or more. And so,
Okay, so Angie, I have 5,000 bushels.
5,000.
I want to buy a put.
Yes. So what you would do is we would take a look, and I'm not a broker. First off, let me tell you guys straight up in that regard, and I'm not here to sell a service or sell an option strategy by any means. But if you did want to get a put in place, you would reach out to your broker and you'd say, hey, I've got 5,000 bushels worth of risk here. I need to go ahead and get this covered. I'm afraid that the market's going to move much, much lower. So, using price, let's say the board is at 470. And you look at your put options and where they're trading, and you want to look at 470 would be an at the money. The board's at 470. Your put you're purchasing is at 470. It's directly at the money there. A lot of times that's going to be more expensive, obviously. Option strategies are like insurance, car insurance, house insurance, whatever. Like, you can over insure yourself. You can spend as much money as you want to buy whatever options that you want. It just may not end up paying in the end, or it may not provide you the actual oomph that you think you're going to get. But in the instance of I'm Farmer Paul, and I've got 5,000 bushel of corn, and the board today is at $4.70. The first thing you want to look at as a farmer is, what are you wanting to spend for protection? What are you trying to protect? And what are you working to accomplish by putting this put in place? And so you would look at it, you would say, okay, I want to protect this for 60 price. I only want to spend 15 cents or so. And so when you're buying these options, you're going to have to think of what month you're trying to protect. If you want to pay for the time value or not, that's where your broker comes into place to kind of work with you on the ROI of the option itself. What kind of return can you expect from this option strategy? And so you're going to look at it. You're going to get an option in place. Let's say you end up buying a 460. You spend 15 cents to do so. Your new floor is now 445, but it's 460 less your 15 cents. A put works. The more you move, you move below 460, your put's going to gain in value. And it's a very simplified sort of explanation. But basically what you're going to do is, if you buy a 460 put, you spend 15 cents. That's going to gain in value. The 15 cents is going to grow if the market moves lower. And then you get to decide how you want to manage that. And that's the reason where, folks talk about 90% of options expiring worthless. Most of it is because you have to make a secondary decision on how to manage these options once you have them in place.
So this 460 or 455, when I've bought that, well, I want to go back. You said something about, I see what my price options are. Is everybody's put prices the same?
Yes, the market it's a bid ask function,
The market,
just the same. You have
fair enough.
it's a whole other market that you have that's trading. You have buyers and sellers, and they are putting a value on what they think those options are worth at any given strike price.
And my 5,000 bushels at 470 on the board, I could sell today, straight up, straight out, get my 470. But let's just say it's my December, it's my deferred contract. I don't have it. That's usually where I'm using this type of strategy, right? Not on a physical. Okay. So I think this might go lower, but I want to capture what my 470 is, and that's why explain that one more time to me.
Yeah, so basically what you're doing is, you're going to buy a put because you think the risk is that the market could go higher, but you want to make sure that you have protection in place in case it doesn't.
But what if I doesn't everybody want the market to go higher? If I'm the farmer, not necessarily the end user. I understand that, but
the farmer always wants the market to go high. That's what a put provides you that. And so, I'm trying to make sure I use my words nicely so that I don't come off and throw an entire strategy out of the water, out of the window here. A put will provide you downside protection. A put does not guarantee you that you've locked in margin, right? So if you don't sell the 470, but you buy a 460 put for 15 cents, and the board ends up closing at 450, you spent the 15 cents on the put and which might have finished worth a nickel because your time value has eroded, and we would finish worth a nickel because you have your intrinsic value. You have the 460, it finished at, it's finished at 450. I have to remember my hypothetical numbers. So you gained a dime. You had a dime of intrinsic value. You locked in the 460 protection. The board closed at 450. The put you spent 15 cents on is now worth a dime. And the corn, your cash corn that you get to sell, is worth 450. So there are times to where you'll have folks say, well, just buy a put, it'll help you sleep better. And it will, because I'm going to talk out of both sides of my mouth, right? But it will to a certain extent, because let's say you would have bought that 460 at the start of, let's go back in time to the middle of May, right? The market was higher. You could have bought a 460 put for probably pretty cheap. And the board on its lower side had traded down almost 30 cents below that. You have ways that it will help you sleep better at night. Folks that own puts, when the board drops 60 cents, are going to feel better than those who do not, even if the put isn't generating the amount of money that it would need to make them whole. But a put strategy allows you the ability to keep your upside open and feel like you have your downside protected. But it also needs to be paired with a good marketing strategy to actually work.
Okay, we'll get to the marketing strategy in a minute, but I think you just answered my very opening question of, in volatile times and things that can happen quickly
Yes.
when we're asleep or napping, this is a time when this strategy or action that I have done helps me sleep, helps me stay profitable, or maybe not profitable, but helps me not lose money
Yeah.
as much. Or
your other option, of course, the flip side argument that I like a little bit better, in those sort of situations where the market is higher and you're looking at whatever, and we're talking about insurance, because that's what options are. They are insurance. You're spending a small amount of money on what could be a potentially larger payout if a certain situation arises. And that's how options need to be looked at, in my opinion. But the flip side is you'll have a lot of folks push for puts. Puts fit the farmer mentality, because then you get to lock in the higher futures price. Like, you lock in a 460 put at 470 and the board goes to 530. Who cares? 15 cents who? I don't know her name. Like that, whatever. I spent that money. I don't care, because I have 60 cents. The other option, of course, is you could lock in the 470. And if you are bullish still, you can spend money on a call. And at least then, so like you have two different option strategies that you can look at, that if you can't live with yourself, if you miss a certain move, this is good brain, insurance, good sleeping insurance to a certain extent, as long as you're working with someone you trust and you're managing the money that you're spending. Because I have seen folks in very volatile times spend way too much money wanting to continuously be engaged in a market that they just needed to move to the sidelines in as well.
is Farmer Paul going to spend a put and a call on the same 5,000 bushels?
No, you can. I mean, you can do anything you want. But it's basically a negative and a positive, and you're just spending. The only person that's benefiting in that is your broker, the person that's getting commission. And that's not a hit against a broker, but if you're buying a put and you're buying a call, you're pushing on the gas and the brake at the same time.
On
the same bushels.
On the same bushels.
Yeah.
Yes, that's what I just wanted to clarify.
Yeah. If you're buying both on the same bushels at the same time, you're just going nowhere.
And then again, another term that comes up when this discussion happens is, well, doesn't that mean I'm hedged because I have a top and a bottom?
Right. It feels like it. I mean, I honestly, myself, when I first started, I thought the same, like, I was like, oh, well, it's easy to protect your risk. Like, you just buy a call, you buy a put. There you go. If it goes down, you're a winner. If it goes up. And I mean, really, sure, you can own both. I mean, you can. It's a free world. Mm-hmm. Like, congratulations. You're 18 and you have a brokerage account. You can do whatever you want. And no one really, I mean, I guess they'd have the respect. Like, yeah, you can do it. But really when it comes down to it, obviously in a call, you're only going to spend so much. So yeah, if you bought it at the same time, you traded at the exact same time, and you spent 15 cents on a call, and you spent 15 cents on a put, and the board dropped, and your put gains in value 30 some cents or whatever, all you're out is the 15 cents on a call. It's not the end of the world that you did it, obviously, but it really doesn't, it's not really going to do a whole lot for you in the long run, to manage risk.
Okay. So then what, okay, again, Farmer Paul has his 5,000 bushels. It's the first part of July. I'm talking about December bushels. Well, that's what we're looking at, is that
Mhm.
December contract.
Okay.
Is it more expensive to buy protection? There's always uh, well, you're buying the farther away months or your farther away time. Am I talking about buying months
Mhm.
of physical time or months on a contract?
Months on a contract, but it also has physical time, and you're paying for that time. So that is a factor that you want to kind of put, or take into consideration. And brokers will look at this differently. Like, I have customers, like I said, I'm not a broker. I don't do options. Like, I let my customers, or I have my customers, work with someone on the outside of that. And, we kind of will all work in collaboration on what makes sense. Some brokers think that it will make the most sense to spend more money to have more time value and the ability to make more. Like, I kind of look at it as, just placing a bet too. The longer you have for it to be successful, and the wider range you give it to be right, the more likely you are to have it hit. And so it's the same sort of thing. Like, if you're going to pay extra money to have until December to see if this market trades to a certain value, than you are to wait until the end of June for a July contract. And so obviously there are some things that you will take into consideration and work with your broker on. Option expiration for if option expiration for July bushels is a week away, you're not going to buy a July, unless you know what you're doing and you're doing it for a reason. If you're working to protect your risk or whatever, you're not going to buy a July option that's a week from expiration and have that work. But you also don't necessarily need to be thinking about, oh, well, I may not move this corn until next July. I should buy a July 27 option. You don't need to do that either. It'll be something that you'll want to work with someone that can take into consideration the parameters and the time frame of your risk, and also factor that into play when deciding what option you buy.
And there's then a concept of rolling down my puts that to protect myself. Walk me through that just briefly.
Yeah, so you have the rolling of options either way. You can roll a put, you can roll a call. Like, basically, once you have a position in place, the key component of an option or the key components of an option are your strike price, which is the futures price that you're betting on. Like, that's the way I like to put it. It's like the horse you've chosen. That's the 460 December corn that we're talking about. That's our,
Mhm.
so you've got your strike price factored into play there. And you're looking at it. Let's say it's working for you, right? You bought the 460 put, and all of a sudden the board is at 440, and you paid 15 cents for this put at 470. It is now worth 30. I'm please don't double check my math. I'm just kind of, but it's now worth 30 cents. I can just see some broker out there being like, that's impossible once you factor in intrinsic and, but it's worth 30 today. To me, what I've always done, or what the conversation that we have then at that point is, you can take that 460 put that you have that's worth something. It's worth that 30 cents. You sell it because you bought it, you own it, you sell it, you take that 30 cents and you put it in your pocket. If you roll an option, that would be then that you would take whatever it would take. Let's say the board's down to 440 and you want to now own a 430 put. And that costs 15 cents. That's what you're going to do. You're going to sell the put that you own, and you're going to determine at what value you want to re-enter your new strike price with, what kind of cost or money you want to allocate to that new position. And then basically you're just kind of putting money in your pocket, and moving your protection lower, as the market moves in that direction. And I like it. I use a lot of casino analogies when talking about options with my farmers, because, to be completely honest, like, yes, there are ways that will help you manage risk, like we talked about, but there are also ways that you just need to look at it as what it really is a margin enhancer, or an attempt to make additional margin, as you're marketing your grain and things like that. And so the adage I always use is like when I go to the casino and I play the slot machines, which I'm a nickel slot gal. But I walk in with $100, let's say, to the casino, and that's my money. If it's gone, it's gone. And I like to look at that the same way for options. You have X amount of dollars allocated for your options ahead of the season, and that's your money. The same could be said when you're in an option position that's making you money. Like I like to, if I am up on the slots, if I put in $20 and all of a sudden I've won 80, I take that $60 and I put it in my pocket and I keep playing on the 20 I came in. And that's what I like to try to think about with options as well. Is just basically we're not continuing to stuff money into the machine necessarily, but when you're rolling an option position, you're making it work for you and you're making sure that you're taking some of that equity out of that position that you've entered into and putting it into your pocket.
I was going to ask you for a review, but you just did it right there. I was going to say, let's summarize one last thing. One tiny little thing, though. You said it already. Those who make money on options, calls and puts, it can be Farmer Paul, but it also is the one who takes the order and places it for you.
Yes, and there's not anything, I have zero ill will towards anyone out there that's on that side of the business. I'm going to say that completely unequivocally or whatever. Like I want to make sure that but as a farmer, especially in the current market structure, it is very easy for someone to convince you that you shoulda, woulda, coulda, or that you still can. And so just, be really aware of what you're working to accomplish when entering into any option strategy, especially because right now, we're only, it's only a nickel. Oh, it's only a dime. Oh, it's only 15 cents. Yeah, that's your margin. That's literally the money that you're making on the bushels that you're producing. And if this can't pay out, then you're going backwards now. And I get the desire to always kind of be involved in the market still in some way, shape, or form, or to have some sort of way to still gain from a position or not lose from a position. But you just really want to be careful that you aren't overdoing it. Like I said, I had a customer one time, this was 2013, so it was a different world. Obviously we were very volatile and very
we're coming out of a drought.
Yeah, it was a very different world, but I can remember vividly still that he totaled it up. He called me, he said, I have followed my broker's advice to a T. He said, I have spent $1 on options this year. Or he said, I spent $100,000 on options this year. He was a 100,000 bushel producer of corn. That was it. He spent $1 a bushel on corn. And in 2013, like maybe we did have that kind of margin still shaking around, but no. And so just be very, very careful that you know what it is that you're wanting to, like, if it's a suggestion to you, if the broker is calling and saying, hey, these are the things that I think you should do. Okay, why? And how long do we give it? What is the time frame? Because that's the thing. Like I said, options tend to expire worthless because you buy them and we just forget they exist if they don't work for us. But like maybe we liquidate them if it doesn't work for us in 4 weeks and we still pocket that dime of time value or whatever. So just make sure that you aren't just going into it thinking, this is going to be the thing that fixes my life.
But it is something to consider,
Yes.
and it's something to learn about,
Understand.
and that's why I wanted to cover it with you here in summer school.
Yes.
The last thing that I want to cover in our few minutes left is I want to talk about the number 67. Let's talk about retracement.
Yes, okay.
And there is a technical term, and there is one of our analysts who loves to talk about it often, is the 67% retracement.
Yeah.
What does that mean?
So I am not 100%. Like if you look at Fibonacci retracements, like you've got 38, 50, and 62 percent. Like there's certain numbers.
62, right? Not 67.
Okay. I was thinking maybe we were hanging out with a bunch of 8 and 9-year-olds. Colton's kind of fell into the 6, 7.
You answer that question while I Google it. Okay, no,
that's it, right. So we have the 62%. So you've got Fibonacci, is a well followed, like so well followed that I even included it into my, intro to marketing class simply because it does seem to work so well. And it's just 38%, 50%, excuse me, and then 61.8%. I say 62. It's close enough for the girls I run with. They're numbers that we really closely watch. They tend to act as, I call it a point of reflection because I have nothing else to really go off from. And so like on the technical side of things, to me, I always look at a couple different factors at play. The biggest thing I look at from the technical side is old highs and old lows of contracts. Even if it's not that specific contract, like once the July board breaks its, to new contract lows, okay, well then what was the May low before that? What was the March low? Like you saw in June, the July corn board went exactly to the old trading range of the December last year and the March when all we did was trade from 404 to 424. And so there's certain things there that you'll watch. But Fibonacci, so if you have a move that's $1 higher, let's say we rally $1, the first thing that the Fibonacci says is that you'll lose 38 cents of that. And if you lose that 38, that's 38%. I'm a simple person, 100 cents, right? So if you lose that 38% and you hold it, you'll probably maintain. But if you lose that 38% level, if you lose that 38 cents, you're probably going to move to where you've lost 50% or 50 cents of that dollar move. If you hold at that 50 cents, you will have buyers come in. They will say, okay, we gained $1. The board since lost 38 cents. I'm going to come in today and I'm going to try to own this and see what happens. I'm going to keep my stops close though, in case it keeps moving lower. It keeps moving lower. Next target's 50%. And then it's 62. After that, we basically black out and we retrace the whole entire move and then some. Honestly, that's about the way it goes, I think. At least that's my experience. But those are good. And so then once you completely lose the move and you establish what the new low is of the move or the new support, then you tend to see it retrace. Okay, well, let's say we gained $1 and we blew all the way through all the Fibonacci retracements and we lost $1.50. Now we start over again, 38% of that $1.50 on the gain side. Same thing. If we gain it and we fall back, then that's what we're going to do. But then we might gain back 50%. And then we might gain back 62% of that $1.50 that we lost. And then maybe we gain it all back. And so it's just one of those things that, from a simple standpoint, if I could get it across to farmers when it comes to understanding when the market is ready to make a pivot or a transition, like the technicals really do come into play and they are something to watch. If we fail at an old high and see selling come in, or if we try to trade to new highs and can't, every day it's a lower high. There's certain things like that you can pay attention to. And then you don't feel as caught off guard if a move completely becomes mature, right? If we lose 62 cents of $1 that we gained because we failed at 38 and 50. And so that's really where that comes into play, is just kind of recognizing where the stops are along the way on a chart.
And those are topics we have covered in some of our previous sessions, talking about waves, talking about head and shoulders and lines. I was sitting there having a beautiful mind moment while you were talking there, because I was like, I should put a whole bunch of these lines over while we're talking, because I see these charts that y'all send some days, and I go, okay, I see it. Yep, there it is. Oh, I wouldn't have. Okay. Oh, that's a definite shoulder that's starting to form.
See them. I'm terrible. It's like those Rorschach or the dots. Yeah. Remember the late 90s with the 3D pictures? Like I just sit there and cross my eyes and pretend. Ooh, that's so cool. I feel that way a lot of times with technical. It's so like, I'm not saying that to take away from what anyone's doing on the technical side. It's super important, and there are a lot of people that's what they trade. From a managed money standpoint, from a farmer's, whatever, technicals have a big level of importance, but sometimes we can just make them up too. Like here's the puking dinosaur chart, and it's December.
Right, and if that's the way that pays for your boat, great. Right. That works
Congratulations.
out. But I will say, I'm going to guess here, Angie, that those technical things that you just talked are part of the foundation that's into the algorithms and into the computers. And they are looking for that.
Yes.
Not saying that's the only movement in the market, But that is something you are working against as a human, against a
Hmm.
computer, and the humans that have the
And they
computers.
don't have the emotion
That's-
attached to it. So like if like for me, sometimes I'll be like, oh, if this fails today, at this level, it's going to be really, really bad. Like, and I can see it, and then it'll fail, and then I'll still do nothing about it. Like, you know what I mean? Where like, because I might be wrong, I second guess myself or something like that. An algorithm doesn't do that because it has a plan B in place. So like, if it sees something happen and it shouldn't happen, it's not going to sit and think about whether or not it's smart enough to make no, it's going to pull the trigger. It's going to pull the dang trigger. It's just going to do it. And then if it's wrong, it's going to recover from it and eat the 4 cent loss that it had or whatever and move on. As a human, we're at least for me, I'm too emotional sometimes about whether I am right or wrong on something.
And I know we discussed emotion heavily in our 200 session that we did a few months ago. So again, if you're watching this after seeing this in our newsletter, I have linked to those past, but we always appreciate whenever you put us into the classroom, Angie. It's always good. I have some more things written down. So guess what? We'll do this again sometime soon. All
Excellent.
right.
I hope so. I really do. I enjoy the heck out of these.
Angie Setzer, thank you so very
Thank
much.
you.
We are produced at Iowa PBS. Our production supervisor is Sean Ingracia. His crew is Reed Denker, Kevin Rivers, Julie Knudsen, Neil Kyer, and David Feingold. The executive producer of Market to Market is David Miller. I'm Paul Yeager. We'll see you next time.